Okay, we are back. I'm very happy to be talking with Daniel Rudnitsky, who is a portfolio manager, and he's on the investment committee of a company called SMH Capital Advisors, which specializes in fixed income. Daniel, real pleasure to have you.
Great. Thank you for having me. I appreciate it, Doug.
So first off, let's get some definitions in place. I already used a term that a lot of people aren't familiar with. One of them is fixed income. And the second thing is you deal especially in what are called high-yield bonds. Could you give us a little background on those terms?
Sure. Well, fixed income or bonds, which basically is a company is asking for a loan to somebody, to the market as a whole, and the clients or the people who are buying them, the bonds, are actually giving them a loan, and it's a promise to pay it back. That's really what fixed income is. High-yield bonds specifically are rated triple B minus or below by a rating agency such as Standard & Poor's. They have a higher required yield than a similar maturity bond, which is just the length that the bond would be out there for. And you need to be compensated higher, that's why they're called high-yield bonds, for the additional level of risk, because there's some additional level of risk within those bonds. Oftentimes it can mean one of a couple things. It can mean that the company's had some problems or has a lot of outstanding debt versus the amount of assets that they have. Other times it just means that they're a small company. A lot of your listeners are probably small business owners. A small business owner wouldn't be rated AAA even if they have a fantastic business. They'd probably be rated as junk or high yield, below investment grade, because they just aren't that large. Typically it takes billions of dollars of sales to become rated as an investment grade company.
Mm-hmm. Okay, so I didn't want to bring up the term, but
sure.
You use the word junk. So tell us, people get afraid. Of course, I would be afraid if my advisor said, "Hey, let's buy some junk." Where's that term coming from, and why is it appropriate in this case? So
that I don't love the term, and I don't use it too often, and that comes really from the 80s with Drexel Burnham and the junk bond kings, Michael Milken, back in the day when it was a relatively nascent asset class, and people were selling it kind of like hotcakes and really not understanding as much about what it was, and it's because it's below investment grade that it is called junk. Less people use the term now, but it's still around there, and it does scare people. But it just denotes that it's below investment grade, and it has a less likely ability to pay back the principal and interest than you would have for say a AAA company.
Okay, so and you had also mentioned before another term. You said that high yield bonds have a higher required yield. Who requires that yield?
So the investors, the public, the market. So if I have two companies, one is just a golden, wonderful company that has a tremendous amount of earnings and doesn't have any capital outlay practically, and is just doing fantastic and been around for 20 years, and you see wonderful growth in sight. I might say, wow, that's such a wonderful company. They only should have to pay me, if I want to give them a loan, 2 or 3% for that per year in interest for that 5-year loan. However, if there's a newer company out there that's a smaller company and they haven't quite built up that base yet, you might say, hey, they have to pay me 7% or 6% for that same length of loan. It's like getting a mortgage or a credit card, right? You have a great FICO score of, say, like 860, 870, and you're going to get a loan for your mortgage, say, 4.5%. But your neighbor might have had too many credit cards. So, but they have a good job, they make the same amount of money as you. They're going to have a lower FICO score, and they're going to have to pay a higher rate to get that same mortgage, maybe 5%, 6%.
All right. We are talking with Daniel Rudnitsky, who is a portfolio manager at a company called SMH Capital Advisors down in Texas. He's given us a few minutes now the background of some of the terms, talking about what are high yield bonds, what are fixed income, what is junk, what do yields mean. Now let's dive in, Dan. I really want to get some details so the listeners can have a takeaway. When we're talking about junk bonds, and let's call it that now because I think I want people to be aware that we're talking about lower quality bonds. Who are the investors for whom this is most suitable?
Well, actually anyone who requires income and some total return. I'm sure that's not exactly what you're expecting to hear, but over the 26-year history of high-yield bonds, there have been only 5 negative years. They have a 9.6% return over that same time period, and approximately half the volatility of the S&P 500 during the same time period. These are, returns have been commensurate with the stock market during that time, and the difference is that the companies guarantee the return unless there is a bankruptcy. So you're guaranteed to get it back, unlike a stock, which can go up or down, and there is no guarantee which way it's supposed to go.
Also, if there's a bankruptcy, it doesn't mean you lose everything, right?
No, recovery rates are actually quite high within it. So you may not get the interest payments back that you were promised, but you can get recovery of principal during that time, and sometimes you get more depending on the bankruptcy and how it goes.
All right. So when you're looking to find a bond or to identify a bond that maybe isn't a particularly high quality, how do you know, or what are some of the main traits you look for to determine whether it's a good investment?
Certainly, we're looking at the business, right? Is it a business that we think has the ability to meet its obligations and go on and be a good business model for the duration of the bond that we're getting? It may not be a fantastic business. It may not be a business that we think is going to be around in 20 years. But if our bond is maturing in 3 years, we want to make sure it's going to be able to meet its obligations 3 years and beyond. So one of the main facets that we look at really is the balance sheet. How much? What are their assets? What are their liabilities? And they're real assets. We don't look at goodwill as an asset. It's got to be a tangible asset for us. So we really dig into the balance sheet when we're looking at the business, and then understanding, continuity of management, who they are, what is the industry they're in. You can be in an industry that's just as a whole suffering a little bit, but it doesn't mean that the company is bad. Are they doing bond-friendly activities? Are they, reducing their spending? Are they selling off non-performing assets? Like the coal industry is a great example. Coal has been out of favor. But it may be something that you might be interested in if you understand how to look at the asset class and the individual companies within it.
Also, a lot of the bonds that people buy are not only a loan that they make to the company, but it's often a loan for a specific project where there's a specific asset backing it. Would you consider those a better deal?
We do like what are called first lien or senior secured loans, yes. Absolutely like to have assets tied to it or be first in priority to be paid in the case of a bankruptcy.
Given kind of the trickiness of navigating through the high-yield bond market, if an individual wants to own high-yield bonds as part of his portfolio, what's the best way for him to get into it?
The best way is through an outside manager because of the amount of research and knowledge and information that goes into it. It's a place that you just the trading costs alone, if you don't work actively with traders and reduce those trading costs, you can get just hurt on right there. On top of that, just the information you have to have about the different sectors, the individual companies, is a tremendous task to have at hand and to navigate, especially because it's hard to buy. You can't buy hundreds of bonds on your own. You wouldn't be able to do that and to manage it. But even buying, as we do, just 20 to 40 bonds at a time for somebody is, we think, an appropriate way to go. You can also go into certainly mutual funds, and you can go into ETFs. Although high yield is very interesting, you can't replicate the index because you can't buy all those bonds. So even ETFs, though they're a low-cost alternative, they've actually underperformed the index by 2% annually over time.
Mm-hmm. So there are 3 ways you've described. You can go with an exchange-traded fund, you can go with a mutual fund, and you can go with a money manager, which is your company, SMH, works on the last 2, right? Yes.
We our main area is actually separately managed accounts where the individual client owns the individual bonds, unlike a mutual fund, and that's actually our preferred vehicle for most people.
So what's the benefit to the client of doing it that way?
The benefit is that, A, you own the underlying securities, right? So there's a herd mentality at times. You can see outflows in bonds or stocks or whatever it is in mutual funds, and you realize gains or losses because of other people within there, and you're subject to those realized gains and losses. The nice thing about a separately managed account is you're not subject to that. You'll have unrealized gains and losses, but those will come back in time because bonds revert towards par. So you're not subject to what's happening in other people's portfolios. We prefer the individual management of the bonds for people.
Okay, that's a very good summary. Dan, we're just about out of time, but in the last few seconds, can you just tell people how they could learn more about what you're doing?
Sure, we'd love to come to our website, which gives you contact information for us. The website is www.smhca.com.
All right, and what we'll do is we will put a link to that at the website goldsteinongelt.com at the show notes. We've been talking with Daniel Rudnitsky, who is a portfolio manager with SMH Capital. Dan, thanks so much for your time.
I appreciate it, Doug. Thank you.
You've been listening to the Goldstein on Gelt Show with money maven Doug Goldstein. Doug's weekly radio show is heard around the world, but if you miss it, you can download the podcast at www.goldsteinongelt.com. The Goldstein on Gelt Show gives you up-to-date financial ideas so you can get on the path to financial freedom. If you'd like your questions answered on the air or off, send Doug an email to doug@profile-financial.com. It's your money for your future, so join Doug every week to build your wealth on the Goldstein on Gelt Show.